There you go. All right, we're recording now, Doug. Go ahead and get started.
All right. Good afternoon. Welcome to the Market and Economic Update, hosted by Doug Gibson and Jason Lee. Thank you, everyone, for joining and participating, and for those who will be viewing this after the fact. The reason that we wanted to host this call is obviously there's a lot of stuff going on in the market, and I continued to get questions and phone calls, and Jason and I finally put our heads together and said, instead of trying to answer these questions one by one when clients reach out, let's be proactive, because we are working on these things every day. We are cognizant of them, and we are reviewing how these things impact our clients and our plans and the accounts and the way that we manage money, as well as our thinking moving forward. So we want to be more proactive with the way that we communicate these things. And this is certainly an avenue to be able to do it, so that you can not only experience the headlines that you see when you turn on the news or any sort of periodicals, but you can have an understanding, especially for our current clients, how these things are impacting our thinking and ultimately going to impact your investments and portfolio if we are working together. So hopefully this is the first of many market and economic updates, but this one is going to be the first one for October 19th of 2023. In order to kind of figure out where we are today, we're going to look at this in terms of a holistic approach, starting with where have we been? How did we get to where we are today? These are the numbers that you see on TV. Obviously, this is a few days ago when I created the presentation, but these are the numbers that you see when you turn on CNBC or MSN or Wall Street Journal. These are the returns that you see when you turn on the TV. This is the S&P 500. This is the NASDAQ. You really don't have to focus a lot of attention on those things, but down here you have your Dow, and you can see the returns have been pretty varied year to date. When you look at something as focused as the NASDAQ at 28%, but then you've got another index which includes a lot of the securities that are in the NASDAQ, negative for the year. So let's kind of take a deeper dive and try and get an understanding of what these things mean, and to understand why your portfolio may be acting the way that it's acting. This is a breakdown that I get on a weekly basis, so that I can really kind of read between the lines and figure out what's performing, and hopefully tailor investment strategies to take advantage of these opportunities. But there's also some critical information in here because of the headline numbers that we just talked about. We know that the market is up, the NASDAQ is up 38%, or excuse me, somewhere in the 30s. The S&P today is about 12% for the year. But when we look beneath the hood, this is a breakdown. There's 11 different sectors or components that comprise the S&P 500. And each of the performance, and we're just going to look at year to date, but you can see that's very top heavy. Okay. Only 3 sectors have really produced outstanding gains to get us to that 13 to 14% return of the S&P 500. That's consumer discretionary, information technology, and communication services. Now, I won't give you all the breakdown in between on this particular slide, but this is where Google and Apple and Netflix and Tesla and Amazon, that's where these particular companies are. But when we look at the rest of the sectors and things like industrials, energy, materials, financials, healthcare, real estate, year to date, you've still got almost half of the market negative for the year. So when you look at your statement and you see data that doesn't translate with the returns that you're seeing on TV, you have to really understand the components of what's making up those returns, so that you can translate that into reading your statement. So there's been a lot of variability, and this is incredibly uncommon for the market. You typically see, when returns are high like this, you see a pretty consistent pattern of positive returns across all of the sectors. One of the things that I always look at that kind of reinforces what I just mentioned is there's an S&P 500 equal weighted index right here. That's basically taking all of the 500 stocks that are in the S&P 500 and rating them equally. So the same percent for each one of those companies. And the returns on that index year to date, again, as of the 13th, is just barely positive. I mean, it literally with the rally a few days ago, just turned positive for the year. So how do we reconcile that when we see the headline S&P up 13% for the year, but the equal weighted S&P 500, which is a more realistic measure of the actual market, it barely positive? You really start to understand the rationale of how only a few stocks are driving the returns in the market. And that leads me to this slide. The particular stocks that are driving the market, we all know the names. It's Facebook, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia. There's, you can add one or two to that depending on, which Netflix, something like that, if you want to follow it. But looking at the data from those particular stocks through June 1st, those 7 are up 53% year to date. The remaining 493 companies, again, are barely positive for the year. And if you average these with this is where you get a better picture of what the number you see on TV when you see the S&P 500 performance. So what that means for investors is, unless you happen to be fortunate enough to hold one of these stocks in a very heavy allocation in your portfolio, your returns have not tracked what you have seen if you watch the news and follow the S&P 500 that they report. If you were someone who holds a lot of those stocks, then you're obviously very happy this year. But what happened to those same companies last year? And this is why we always favor a diversified approach. Going back to 2022, the first part of 2022, you can see those same companies were down almost 40%. That's the red line here. So they range between outperformance and underperformance, but the companies that are now creating all of the performance this year that investors are very happy holding are the same people that were very unhappy holding those same companies just 12 months earlier. So, again, we can't be stock pickers to a certain extent. We try and rely on fundamental analysis and create a diversified, balanced portfolio to give investors a.
Kay dalaan siya. Metformin.
Mani Mario. Ready chair.
If someone just joined, would you mind muting your line? So you can see how the volatility on those 7 stocks, again, has been very rewarding for investors this year. But just in previous months, it was a drag on the portfolio. So you would have seen better returns in the equal weighted S&P 500. So we really want to try and understand what's happening to create a balanced approach and a diversified portfolio so that you can really smooth out as much volatility as you can while taking advantage of opportunities that are in the marketplace. Taking a deeper dive even further underneath the hood and looking at some of the things, the progress that we've made historically, there's an investment firm that generates something called the Value Line Median Stock Index. It basically is an average of all of the stocks. There's about 1,700 stocks, and they publish this like a mutual fund. And this is very much representative because they're all equal weighted, but it's a little bit more broad index than the S&P 500 equal weight. But this takes into account some of the smaller companies and the larger companies together equally weighted. So you can see from a holistic approach, what has the market actually done for the average stock? And I drew this red line on there. This is, again, is an index that you can look up and you can track it yourself. But this is pre-COVID. This is the highs from before the COVID. And we obviously had a deep decline right after the pandemic. We had a rally when the economy started to reopen. But look at where we are today versus where we were 3 years ago. We're actually down on the average stock just than we were before the COVID pandemic. So we have really yet to recover. So when most investors are looking at things and they haven't made a lot of progress, this is exactly why. And so we just, again, want to look at the data and try and understand why we're seeing what we're seeing. And if we continue to peel that back a little bit further, This is a metric, a chart that I watch quite a bit. It's the new highs over new lows, and so you can see in any market environment, you have stocks that are advancing and you have stocks that are declining. When you have a rally like we had in 2020, this is what a normal market looks like, where the number of advancing stocks is outweighing the number of declining stocks, and that's what makes these levels green. So in a rising market, we would expect to see a lot more green than we have red. Well, let's move that to starting in July of 2022. We've got a nice rally here, so the market has moved up, but look at the market action underneath the hood. You've got a lot more declining stocks than you have advancing stocks, but yet the market has moved to new highs in the middle of the year. So, you know, fundamentally underneath the hood of the market, it is not structurally sound, even though the market has continued to increase and move to new highs. And that really reinforces the fact that there's only a handful of companies that are driving this outperformance. Obviously, for clients, we're always diversified and balanced. So the flip side to this is bonds. We all know what's going on with interest rates, but you know, traditionally bonds have been considered a safe asset class, which is why people balance a fixed income portfolio with an equity portfolio to try and balance out the risk and reduce risk. Well, based on the rise in interest rates, this is a chart that compares the decline that we've seen in fixed income in a treasury, one of the most safe assets on the planet, compared to the market decline during the great financial crisis in 2008, 2009. This is the S&P 500, the blue line during that period of time. You can see the drawdown, the decline during that period was almost 60%. When you factor in that the treasury, one of the safest assets on the planet, has now exceeded that drawdown. So anyone holding a safe, quote unquote, asset class has experienced greater drawdowns than stocks experienced during the S&P 500, you really start to see how significant of an impact the increases in rates have had. So anyone that's been holding this quote unquote safe asset class to try and diversify risk has actually not balanced their portfolio, because the returns that have been generated have been far worse than if they had held stocks during the great financial crisis. This is a tweet that I think really sums it all. It says, in terms of total returns, this is the biggest bond market rout in 150 years. Last year, which would be 2022, was in fact the bond investors' worst year since 1871, with a total return of minus 15.7%, even worse than 2009. For 2023, year-to-date return has been minus 10%. That's almost 17.3% combined, even worse than 2022. We're looking at bond investors' two worst years in 150 years. So I think that pretty much sums up where we are, which made it very hard for people to handle managing their portfolio, because there was no place to hide. We were getting, you know, not great returns in the market, and then we're getting historically bad returns in the bond market. So it definitely made managing your investments in your portfolio pretty challenging. Just how challenging really kind of reinforced the common theme for most people has been a standard 60-40 portfolio. That means 60% of their portfolio was in equities, 40% was in fixed income. This is that portfolio performance historically. You can see going back to 1927, it has been really strong. The performance for the most part has been positive. There's been a couple of years where the performance has been negative, but in 2020 and 2021, you can see that it had the worst historical performance on record. So where does that bring us? Where are we today, and how should we think about our portfolios currently? Again, the news and the headlines, you know, tend to drive clicks, but it doesn't necessarily represent how you should feel about the market and your portfolio. This is a chart of the average annual decline from peak to trough in the market. So this red dot here shows you how much the market declined from its high to its low in any given year. And you can see there's a wide range of numbers. This one just happens to be 2008, 2009, which we know was the financial crisis. It was significant. But look at where we are today. And it's pretty remarkable when you look at this, and why I wanted to include this chart, because there's a whole lot of things going on. Ukraine, Russia, interest rate increases, the Israel-Hamas situation, oil and gas, the COVID pandemic that still lingers. With all of those things going on, this has been a remarkably low volatility year in terms of the market, but you wouldn't really think that if you just see what the headlines say when you turn on the news. So I think it's very important to really, kind of take those things with a grain of salt and understand that they are more, that information is designed more to generate interest and clicks and, from a marketing standpoint than it is really to give you information on your money and how it's being managed. Believe it or not, again, this is the most recent data. We're going to get some more data soon, but the odds of a recession are now under 50%. So we can see a few months ago that they were, pretty high, higher than they had been since we actually had the recession in 2020. But those odds have come down. So what that means is, despite the rise in interest rates and all of the impact that that's having in the economy itself has responded pretty well. Jobs remain strong, earnings have been good. A lot of the things from a fundamental standpoint and a reporting standpoint in the economy are holding up pretty well. So the odds of recession are coming down. Now, they could, of course, go right back up, but I think it's important to understand right now the outlook is becoming more positive. There's obviously factors that are going to come into play that could impact this into the future, but I think where we are now is largely positive. I found this very interesting, and I wanted to include this because I was pretty fascinated by it. This is the presidential cycle. We're in the third year of a presidential cycle. The top chart here is an average of the last 19 third-year cycle of market returns of the presidential cycle. And looking at how the market has performed, this is in January through December. When I published this chart, we were at day 189. We're at day 203 now. But you can see the market performed very well. Then we had a peak, then we had a drawdown, and then we finished pretty strong. The chart on the bottom is the actual performance of the S&P 500 to where we are today. And you can see the track is almost identical to what we've seen on average for the past 19 third-year presidential cycles. So, this is, if we are here today, and this is where we are historically, certainly the trend is favoring a strong fourth quarter. Now, there's some reasons I'm going to get into why, but I thought it was pretty remarkable how accurate and correlated the action that we've seen in the market so far in 2023 has matched historically to where we've been in third-year presidential cycles. And one of the reasons that we have to think in terms of investing counter to our psychology is investing during peaks and troughs, how the market performs at highs when consumer confidence is very high, and how the market performs at bottoms when consumer confidence is very low. This chart really outlines market performance at troughs and peaks. And really what this is kind of showing you is you have to go against your psychology and the sentiment. The idea is to buy when things are on sale, and when they're on sale, you're not going to have a very rosy opinion of the market and the economy, but that's when you get the best value. And so I put this chart on here because I want you to just understand that a lot of times when you're seeing the negativity out there, that doesn't mean we want to ignore it and not understand the impact that it's having on the portfolio, but to understand that there's value there. And sometimes taking advantage, really not sometimes, almost all the time, taking advantage of the sentiment when it's negative is the best time to buy. So where are we going? What are we contending with, and how do we figure out where we're moving in the future? Well, this is the big one, the Treasury yield curve. You can see this is where we are today, where we were a month ago, and where we were a year ago. This is more of a normal yield curve. When the lower end, you get a lower return, and on the higher end, you get a higher return. This is what's called an inverted yield curve. An inverted yield curve up until now has preceded almost every recession except one going back 100 years. So that's really when people start to predict recession, this is a big factor. But we're starting to see the yield curve normalize. So you can see the range here. What we want to see is for this to be up above the short end. So it would be this kind of curve. That's a more normal yield curve. And it's starting to happen. You can see where we were a month ago and where we are today. Obviously, the rates as a whole are going to be higher, but in order to have a normal yield curve, we need to get higher rates at the longer ends of the curve, because you want to be compensated more the longer you lend your money. And that's what the normal yield curve is showing us. So you're starting to see it correct. How long that takes is going to depend on a lot of factors, but I do think it's moving in the right direction. We just heard Powell, the Fed chairman, speak today. This is what's called the Fed dot plot. This is a chart. There's Fed governors, there's 12 of them, and each of them vote at each meeting on where they think rates are going to be in future years. The reason this is so significant is because you can see the trend. They are all almost unanimously predicting rates will fall in the future. The Fed wants to get rates somewhere around this level between 2.5% and 3%. So the rate increases that we've seen, they're all saying those are temporary. So they expect them to hopefully come down in 2024, follow in 2025, 26, and reach where they want them to be long term. What does that mean? That means they're all expecting to decrease rates in 2024, 2025, and 2026. Now, how much is really based on the individual's interpretation and how they see the data. But for the most part, they are all considering factoring in a decline in rates in future years, which would be a good bet for the bond market. That will really help start to create value in the bond market as well as the stock market. We can start to get more home buying. Rates on mortgages and loans will come down, which will stimulate the economy. So things are moving in the right direction from a rate aspect. What does that mean for investors? Well, this is a chart of returns following the last rate hike. So the last rate hike that the Fed announced was in September. We just had a 1/4 point hike in September. If that is the last rate hike, this is how stocks, bonds, the 60-40 portfolio, international equities, and shorter term bonds will perform in the following months. So if September was the last rate hike, 12 months from September, the average historical return on the market is about 15%. Is that's going to be the case? Time will tell. But the trend is historically very, very strong because of the slide we just talked about. If rates start to decline, people are going to start to buy houses, buy more cars, the economy will improve, and that will boost the stock market. It should also boost bonds because as rates increase, bonds come down, and you start to move money into fixed income. They start to become more of a value. So people want to wait a lot of times to get into these things when they see that things are good. And that kind of goes back to the psychology of buying at a peak versus buying at a trough. There's value when you get in when sentiment is at its lowest so that you can take advantage of these kind of opportunities. So long story short, if we're at the last rate hike, or the last rate hike was in September, historically there has been a very strong period to follow for almost all asset class. And this is the reason why. Earnings projections for companies have never been higher. This is the single biggest driver of market, of the returns in the stock market, whether it's an individual stock or the market as a whole. So this is what the earnings projections are in future years. The historical average for 2001 through 2022 has been for an increase each year, an average increase in earnings per share of 8.4%. The expectations for 2023 is that we will have increases in earnings per share 11.7%. So about 30% higher than what we've had historically over the last 12 years. And if that's here, you can see it's only going to continue to get higher. And if we can achieve those returns, the market is going to potentially set up for a nice next few years. Since I talked about the third year of the presidential cycle and what kind of impact and the trajectory that we've had and how it's been very, very similar, I thought it made sense to look at the fourth year. This is the returns, and it may be too small to see in January, February, March, April, and so on. You can see that historically speaking, the fourth year of the presidential cycle has been very, very good for the market. There's only been 3 negative months in the market. And the trajectory or the path on the fourth year, again, factoring the last 19 presidential cycle fourth year terms, the market has historically been very strong. So if the third year path continues the way it has, and we start to get the same type of action in the fourth year, again, when you factor all of these things together, along with an increase in earnings per share in the market, incredibly negative sentiment, that's setting up very, very well for a strong period for the markets, at least through the end of the year and hopefully through certain periods of next year. Just to kind of reinforce that, this is the historical returns for the market month by month. You can see historically, October, November, and December are very strong months for the market. September, again, has really on average been the worst month, which is exactly what we've had. And if you want a statistic to kind of support some of these things, historically, if the market is up more than 10% through July, which it was, and August is down, which it also was, the remainder of the year is up 100% of the time with an average gain of 9.9% and an average, with an average gain of 9.9 and a median of 8.7. So that's factoring in the returns of all of these going back to when the data started in 1970. So again, when you look at all of these things together, we should be setting up for a very nice finish to the year. So wrapping all of this up, let's try and put this into perspective from managing our portfolios. When we sent out the email, obviously this was the chart that everybody saw to talk about where fear is, and you can log on to CNN's website. They post this every day, and you can track the fear gauge to see where the overall sentiment is. I think it's a combination of 6 or 7 indicators that they use to kind of create this gauge. I use it to really kind of understand what the overall psychology of the market is, so we can follow what Warren Buffett said: to be greedy when others are fearful is a valuable mindset that can reap substantial rewards for the investor. So the idea is to follow an investment philosophy, adhere to your portfolio management structures, and not be swayed by the headlines that you see on TV to allow fear to make decisions, because the chart below is going to show you exactly what kind of an impact making decisions from a psychological aspect and a fear-based aspect have on the returns of individual portfolios. This is a slide by JP Morgan. The average return for the market over the last 20 years is 9.5%. During that same time period, the average investor's returns is only 3.6. So about 70% less returns than if you had just kept your money in the market. And the reason for that is that we're letting fear drive the investment decisions that we make. We're reading those headlines, and we're using that information to make decisions in our portfolio that aren't necessarily aligned with our long-term goals and the structures that we have. So when Jason and I sit down and work with clients, we spend a lot of time trying to understand clients' levels for risk and expectation and needs, And we look at all of this data and we create a portfolio or a strategy or a plan that's going to help clients achieve their goals over the long run. Now, we use all of the same data and we look at all of these same figures. I look at these things every day, but we work very hard to try and make sure that our philosophy always aligns with an individual's investment goals, time horizon, and risk tolerance, so that we're not swayed by the things that we see on TV and the headlines and the fear. We want to make smart investment decisions based on long-term principles instead of allowing the way that we feel day to day to drive investment decisions. I added this slide today because I do think it's important. There's always a factor or things that can come into play. We all know, the things that we've looked at, the fourth year of the presidential cycle, the normalization of the yield curve, interest rates. We understand, we can predict, and we have data on those things. A black swan is a term that's defined as an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. So this is an event that you can't predict that comes into play. So I put this slide in there, and I think it's important because, it is a reality that we face. Again, it's something that I face as a portfolio manager, and it's something that you face as investors to try and understand these things and how they impact portfolios. So there are potential things out there, China invading Taiwan, Hamas and Israel, Russia's involvement with Iran, a lot of things that could happen. Some of the earnings estimates may not materialize. Interest rates may continue to increase if the Fed continues to do that. All of these things would be defined as black swans. So they are things that we're taking into account. I don't want anybody who's looking at this to think, okay, well, Doug is a positive and bullish on the market. So no matter what happens, we're going to be invested in a fashion that's retrospective of that and very bullish. We are constantly evaluating data, and all of that data, we are making decisions on portfolios based on that data. So while the things that we've talked about today do indicate that the market trend for the next few months is positive and hopefully will continue into 2024, that doesn't mean that we're ignoring everything that's going on, because there's always going to be things that happen that we will take into account. So when we're working on your portfolios and we're handling your money and we're creating an investment strategy, the way that we feel today may be completely different tomorrow, because there will be new data and there could be new things that are going to come into play that impact how we manage money. We are not reactive to a certain extent. We try to be proactive so that we can make decisions in the best interest of our clients, as long as they are always aligned with their long-term goals. So with that, I will wrap up and open it up to any questions. If anybody wants to ask anything, or if you have any questions, please don't hesitate to give us a type it in, or to unmute your line and ask away.
Doug, thank you. This is Jason. Just a reminder on questions. If you have something Doug can answer, we can always answer from a generalized perspective, but we always have to be cognizant to ensure we're not giving away specific advice to a group of individuals just from a compliance perspective. If you have specific portfolio questions, feel free to email us directly, and Doug will reach out and talk to you specifically about your portfolio.
I don't have any questions. I think for me, this is extremely helpful. It helps normalize any anxiety that people may be experiencing over what's happening, because in learning about how you look at it, it helps me understand your investment strategies as well. So I appreciate it. It's very helpful.
Thank you, Jess. Well, perfect, Jason. If nobody has any questions, or again, if anybody has any questions, you can reach out individually. You want to close us out?
Yeah, for the group, I want to
hey.
thank everybody. Oh, go ahead.
Quick question. Are you going to send this out so that we can have a little more time to look at some of it?
Yes, ma'am.
No,
absolutely.
I can't.
Thank you. Huh?
Yes, ma'am.
I can't.
Yeah, I'm recording it now.
I'll send the recording. I can send the recording. I can't send the slides.
Gotcha.
Okay.
Yeah, I just didn't have anything to write on, so it would help.
Yes, ma'am. The recording happened, and so we will pass those on to you ASAP.
Thank you.
Thank you. Okay, everybody, thanks for joining us today, and we appreciate you as always, and I'll keep you posted, and we appreciate you tuning in. We will intend to continue to do this on a quarterly basis unless significant things flare up and we warrant maybe an immediate discussion with our clients and want to get the news out. We will do these on a more regular basis if those come up. But in the meantime, you can look to hear from us probably by the end of the year or the beginning of next year. And thank you so much for tuning in. We'll see you guys in the future. Thank you. Bye-bye.
Thank you.